Markets are moving, jobs, bonds, inflation, and earnings. Here's what you need to know right now. Welcome back to Navellier Market Buzz. So, Dad, what's your take on the August job reports and the ISM data?
Well, let's just start with the ISM because the job report was probably the biggest news. The manufacturing is improving, but it's not above 50, so there's some green shoots in that. That's good. The ISM service report was excellent. It jumped quite a bit. So that means that the service side of our economy, 70% of our economy, is doing well. So that was another green shoot. But unfortunately, as the Labor Department reported on Friday, we aren't creating any jobs. And we had a downward revision in June to negative. And this is a second downward revision. And this is probably why President Trump is so frustrated with the data. So there's no job creation in America in the last 4 months, effectively. And of course, the August number was only 22,000, well below economists' expectations. So obviously, there's now 100% certainty that the Fed will cut on September 17th. Of course, they should have cut back in June when we had negative job growth now. So I think Wall Street's celebrating that, and it was just a wild week for bond yields. We started the week with bond yields rising over fears of budget deficits in Britain and France, and it did spread to Italy and America, which have deficits as well. And then because of the economic data, and especially the Friday payroll report, interest rates have collapsed. So the Fed cannot fight market rates. So we are going to have a rate cut on September 17th. And they're now forecasting 3 rate cuts. This is the Wall Street consensus. So that's good news.
I want to jump into one of our subscriber questions quickly. One of our subscribers wanted to know where you disagree with Ed on the rate cuts, because you've been saying that the Fed should cut because the economy is doing fine, but he says cutting could spark a melt-up.
It better start a melt-up because that's the whole point. There's nothing wrong with economic growth. The Fed just doesn't want economic growth with inflation. And all economists are trained to fight deflation, which is falling prices. In America right now, we have deflation in the housing market. You cannot sell a house unless you discount it, okay? We have a glut of rental property, okay? We're hoping that shows up in the economic data in the consumer price index. But the other thing is we're importing deflation from China. They've had deflation since May of 2022. And it's now running at the fastest annual pace ever recorded, 3.6%. China is notorious for overproducing and then dumping their goods on the world. And we also have weak economies around the world. Asia has got a household formation problem. They're getting older. Japan has the highest birth rate in Asia, but they don't. It's not high enough to replace all the households they're losing. Northern Europe is losing households due to just demographics. You can counteract that with immigration, but the immigration in Britain, France, and Germany hasn't been going very well. Okay, they've been overrun. They're not assimilating them like they should. They're all this lackluster news on lack of household formation is really hindering growth. Now in America, we're totally different. We have pro-family regions in the South and the Mountain West. In fact, your sister's going to have as her third baby on the way. So that's good for the economy to create a household formation. And we also assimilate immigrants in America. Now I realize President Trump's doing raids and he wants them to be legal. Okay, and he had a pretty controversial one on a battery plant in America. These are all Koreans, I guess, overstayed their visas. So that was controversial because they were working at building this battery plant. But, that's what we're doing. So we're not anti-immigration. We just want them to be legal. So at one time, Ed Yardeni didn't think a rate cut was necessary. He does now because market rates have come down and the Fed never fights market rates.
So bond yields have jumped when the bond vigilante showed up again. What's driving that?
Well, again, the bond vigilantes are worry warts. They like to manipulate markets. You're going to show a chart of something called TLT. It's the iShares 20-year ETF. You've shown it in the past. And it shows you that if you invested in long-term treasuries, you would lose money. And so it's very precarious to invest in the long end of the bond market. The yields did spike earlier in the week, but then with all the economic data came out, they collapsed. But we like to say the bond vigilantes are in charge. The governments can't borrow unless they keep these people happy. And bond vigilantes are big institutional investors. Now, in America, we're blessed that we have a little higher rates than everybody else. We have this household formation. We have real economic growth. And so we're going to be able to manage the debt better than most people. Obviously, President Trump is trying to use tariffs to pay down the debt a bit. And when they reconciled their tax bills, they didn't take that into consideration. But the tariff revenue early in the year was $30 billion a month. Now it's going to be approaching $60 billion a month. And that should help us better manage our debt. But these bond vigilantes, you got to keep them happy. They're very moody people, and they did disrupt the market earlier in the past week. But by the end of the week, rates had collapsed.
Looking ahead, what do you expect for next week's PPI and CPI inflation numbers?
Well, the PPI is going to be interesting because it spiked by 0.9% in July, and it was all due to wholesale diesel prices. It rose 11.8%. And there's a issue on the West Coast with diesel. California would like diesel made from organic things, not oil, and that's a more expensive diesel. And then the diesel they make from the refineries, it's hard to sell. And so two big refineries have left California. One is Phillips 66 in Southern Cal, and I believe it was Valero in Benicia, and that was the most modern refinery in California. But the bottom line is that spike in wholesale diesel prices caused pretty much most of the PPI inflation. So we hope it's going to be a lot better in August. Obviously, crude oil prices are going lower, so hopefully that spike will dissipate. The other thing is we got to watch the imported good costs. Again, they might be moderating because of the deflation in China, but there are tariffs now. So we'll see if that has any impact. And then finally, we have to watch wholesale service costs, which have been well behaved. So that's the outlook for the PPI, and that comes out before the CPI, actually.
What do you expect for the CPI inflation numbers?
Well, it's all going to be about owner's equivalent rent. We have falling real estate prices throughout America. We have a glut of rental properties. So hopefully owner's equivalent rent finally stops expanding. And as soon as that happens, we get CPI at or below 2%, the Fed's target. The other thing is we do have falling crude oil prices and a crude oil glut right now. So hopefully that will show up in the inflation data.
Now, you just finished your quarter end backtest of StockGrader and your 8-factor model. What stood out to you?
I was shocked. The market tightened up. I thought it would broaden out. We've had all these mean reversion rallies. That's where the stocks that aren't so good fundamentally all of a sudden explode. Some of that's caused by short covering. Other times it's caused by the market makers conducting mean reversion rallies. It's kind of how they create artificial liquidity out there. Yeah, you got to be in the top 25% of our stock grader. So that's an A and a B plus. But the fundamental models are still beating the pure quant models, and there the top 5% remains extraordinary, and you really need to be in the top 15%. Before that, it was actually the top 45. So the market is getting a little bit more narrow on us right now, so we got to keep an eye on it.
I want to jump to another subscriber questions that wanted to know if your quantitative analysis is basically the same as momentum, or is there more to it?
No. It's based on alpha, and what alpha is the stock's return on correlated the market. So the best way to explain it, let's just say the market's been up 50%, and a stock has been up 100% in the same period, but that stock moves in tandem with the market. It would get a beta of 2 and an alpha of 0. So the only way you get a high alpha stock is it has to zig when the market zags. And there are a lot of high beta stocks out there that I don't recommend, even though they're strong. One would be Meta, another would be Amazon, and that's because most of their return is tied to the market, not to the stock itself. So I'm purposely looking for a stock that zigs when the market zags. I divide alpha divided by the stock's volatility, and that's my top secret quant ratio. And one last thing, we think we do our alphas and betas better than everybody else because we run them against several different market indices and we use the index with the highest correlation. What I've noticed is a lot of people do their alphas and betas against the wrong benchmark. And the more you do that, the more you get garbage in, garbage out. So there is no price momentum at all in our system. It's literally about finding stocks that zig when the market zags. That's what a high alpha stock is. And that's why we have staying power, because we don't want to be correlated to the market. We want to be successful regardless of the market.
I want to ask one more subscriber question before we get into earning announcements. Did companies pull forward sales earlier this year after Trump's tariff talk? And could that mean a weaker demand later in the year?
No, that's not the case at all. What companies did do is they imported a lot more before the tariffs and they dumped goods on us. That's what they did. But no, they're not artificially inflating sales. We're just having sales. Go to Costco or Walmart or Best Buy. You'll see it.
So we still got some more earnings this week. Let's start with Adobe, the company behind Photoshop. Do their earnings look picture perfect this quarter?
Yeah, they look wonderful. Their sales are forecast to rise 9.2%. Earnings are supposed to improve 11.3%. They have positive analyst revisions and a very good earnings price history. And Adobe, in all candor, is a monopoly. They have the PDF standard, and they're a very well-run company.
And that's actually what software I use, Adobe Premiere Pro, to edit this video.
Correct. And when I was younger, they had software called PageMaker, and I used to publish my newsletters on their PageMaker software. So Adobe is really good in all kinds of production, but in the end, they created the PDF standard, and that's their monopoly.
So next up, we have Kroger, everyone's favorite grocery store. But are they checking with stronger sales?
Somewhat. By the way, I think they're the favorite grocery store for a lot of people because of Grater's ice cream, and it's got a lot of butterfat in that. As you know, the only place that has more butterfat is your old college, Cornell, because they have that extra, I think, almost illegal ice cream, I think. Anyway, back to Kroger. Their sales are forecast to rise 0.6%. Earnings are supposed to be up 7.5%, which is excellent. They have steady analyst estimates, and they have a good earnings to price history. It's okay. It's not in my portfolios, but it should beat and meander higher.
Now let's go over to Oracle, the database giant. Are they going to write a winning script this quarter?
Yeah, that's Larry Ellison, who actually lives down the street, and he just bought the hotel up the street. Oracle sales are forecast to rise 13%. Earnings are expected to improve 6.5%. They have steady analyst estimates. Believe it or not, they have an erratic earnings surprise history, but they are the database giant. Now, Goldman Sachs came out with a report saying that AI data centers might be overextended and be careful. I don't think that's really going to hinder Oracle, to be candid with you. I mean, they're growing their database big time. They were part of that huge initiative to invest in America. And so I think they'll power through this.
And lastly, Synopsys, the chip design software leader. Are they still wired for growth?
Yeah, they are. Sales are forecast to rise 15.8%. Earnings improve 9.2%. They've had some minor analyst earnings estimate trims, but they do have a very good surprise history. So I would expect them to do especially well.
Oh, great. That's a wrap for today's show. And if you found this helpful, please give a thumbs up and subscribe. And we got more insights coming for you your way next week. Thanks so much, everyone.